Massive news for Fubo stock investors as the company announced a combination with Disney and Disney's Hulu Live TV. I'm going to go through the details of the announcement and what it could mean for Fubo stock investors specifically. So let's take a look at the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the announcement said that Disney is to combine its Hulu Plus Live TV business with Fubo and become majority owner of the resulting company. The combined business will operate under the Fubo publicly traded company name, led by the existing Fubo management team. Fubo will also create a new sports and broadcasting service featuring Disney's premier sports and broadcast networks. And finally, the highlight of the whole thing, the reason why Disney even agreed to do this, is that all litigation between Fubo and Disney has been settled. Now, if you've been following Fubo stock, you probably heard of this litigation. Fubo was suing Disney and its partners for the attempt of starting a streaming service bundle that included sports for around $40 per month. Fubo was arguing that was anti-competitive because it was going to hurt Fubo's business. Fubo is a sports-centric streaming bundle priced at over $80 per month, and this new offering at $40 per month was likely to undercut the company's business significantly, and Fubo was already under a cash crunch, losing over $100 million in cash flow from operations in the trailing 12 month. With debt coming due, it was in a tough situation, so the litigation got the company out of that mess. It literally saved the company right now. In my opinion, the the probability of Fubo going out of business over the next 5 years was pretty high before this announcement because the company was losing money, and that was before the increase in competition from streaming sports. And the incoming competition was likely to hurt the business and restrict its growth, and it could have potentially even had the company lose subscribers. So this deal basically takes that off the table. The announcement said that after this deal, the company will be, the balance sheet will be better and the company will be positive cash flow. So the probability of Fubo going out of business now over the next 5 years just instantly dropped close to zero. It's still a non-zero probability, but it's close to zero. Whereas previously, it was a much higher probability, closer to 50%, I would say. But now, down almost to zero. And just that fact alone could justify the stock price increase, which, if you saw yesterday, I'm sure you did, the price was up by over 220% following this announcement. And I think it was justified because you remove that probability of default off the table. So in connection with the transaction, Disney will enter into a new carriage agreement with Fubo that will allow Fubo to create a new sports and broadcast service featuring Disney's premier sports and broadcast networks, including ABC, ESPN, and all the others. Of course, that's good news for Disney, right? It's going to force feed Fubo all of this content and say, you have to take it. You have to create this new network, this new offering, and it's going to be all our stuff. And you have to pay Disney for the rights to this content. And so Disney will get payments and Fubo will be forced to create this broadcast service. Whether or not it's profitable, I don't know if Fubo will have the option to not carry this if it turns out not to be profitable. In any case, that's part of the deal is good for Disney because Disney has a lot of content. It's losing subscribers on the cable side of the business. And so these services like ESPN, ESPN2 could really use an increase in viewership. And this is one way Disney can get that. It's forcing Fubo in this agreement to create this new service. And Disney will benefit because for each one of these, imagine ABC, ESPN, ESPN2, all of these networks, Fubo will have to pay a per subscriber fee, most likely. So imagine every month for every subscriber, Fubo will have to pay, $6 for ESPN, $5 for ESPN2, $4 for ESPN University, and et cetera, right? So these are all fees that will be paid to Disney. These are the same fees that caused Fubo to be in trouble to begin with. You look at the company's cash flow from operations over the trailing 12 month, negative 101 million, and its total long-term debt were rising all the way to 340 million. It's because Fubo wasn't able to make enough money from its subscriber fees above what it had to pay content providers like Disney. It was forced to pay more than it could bring in, and so the business got into trouble because of that mismatch between the unit economics. Cost the company too much to secure the content, and it couldn't charge customers more because it was already, when you compare with Fubo TV, with Hulu Plus Live TV and YouTube Live TV, it was already the higher priced option in terms of what you were getting for the price you were paying. So they go on to say that the combined company will negotiate carriage agreements with content providers for Hulu Plus Live TV and Fubo services independently from Disney. This is bad news for Fubo because uh, Disney, much larger company, stronger negotiating power, that will not benefit this new entity because this new entity is going to negotiate terms on its own, independent of Disney. So you would prefer that it has the clout of Disney behind it when it goes to negotiate these carriage agreements, because the carriage agreements, the unattractive rates of carriage agreements, was the reason why this business was so unprofitable, was the reason why this company got into so much debt and had to sell so much stock, and the market cap had dropped. The price was down over 99% off its highs. Because of these arrangements, the carriage agreements were just not attractive. The unit economics were just not attractive, and they still will have to negotiate independently, which I would prefer they didn't have to. So Fubo will be governed by a board of directors with the majority appointed by Disney, but the CEO will be Fubo TV CEO. The current CEO, David Gandler, will remain the CEO. But it remains to be seen how much influence the CEO can exercise if the board of governors is the majority appointed by Disney. The board of governors has more power than the CEO in the direction of the company. If they don't like what the CEO is doing, they can let go of the CEO and bring in another CEO. Although I don't know if the board of directors will have that kind of power in this arrangement, depending on how many shares David Gandler owns of this new entity. Also, one of the bigger details of the deal is that the entity, Disney, Fox, and Warner Brothers Discovery, which is trying to launch that teamed up streaming bundle, they'll make a payment to Fubo of $220 million as a part of this deal. This is the biggest reason why this deal happened, is to settle the litigation so that these three can launch that streaming service, which is going to be way more valuable than what's going to happen here at Fubo. Fubo, even after this transaction, is an enterprise value of $1.87 billion, right? And so this streaming bundle that is expected to launch is likely to generate multiple billions of dollars in revenue and profit over the coming years. And so that's what Disney wanted to get going. And the litigation was delaying the launch of that. And they were losing opportunity with every month that went on without having that streaming bundle in the market. So that's why this deal took place. Fubo was able to extract a good amount of value based on that litigation. So they used that very well in their advantage to get this deal from Disney. So in addition, Disney is going to provide a $145 million loan to Fubo as part of the transaction. And the good thing about the deal is that there's a termination fee of $130 million payable to Fubo. Because if this deal doesn't close, for some reason, if regulators say, you know what, this combination is going to reduce competition in the streaming TV bundle space, we're not going to allow it to go through, Fubo will still get a fee of $130 million. Isn't it interesting that Fubo was suing Disney and the other providers for reducing competition in the sports streaming space? And this deal actually reduces competition because you're combining two live TV streaming companies together, essentially. And so you are reducing competition. So as long as it's in your favor, there's no complaints. But when the competition is against you, is when there's lawsuits, etc. Right. So the financial outlook looks pretty strong in the aftermath of the deal. The pro forma suggests that they could generate about $6.5 billion in revenue following this deal, with adjusted EBITDA of around 350 million, growing to over 550 million by 2028, with over $7.5 billion in revenue. But more importantly, like I said, it reduces the chance of bankruptcy for Fubo. You see here, they had a 2026 convertible note that was coming due in about 1 year for $145 million. The company already had total debt of $326 million. It was cash flow negative, as I shared with you. They were losing $101 million over a trailing 12-month period. And even if they eked out a positive cash flow this year, which they were forecasting, it wasn't going to be enough to pay off this debt. And it wasn't going to be enough to appease lenders with incoming competition. There wasn't going to be lenders that were lining up to give Fubo money. And so this was a big risk for the company. And if they needed to refinance this debt, they were going to have to pay a very high interest expense to refinance that debt. And then they had another 178 million that was coming due in 2029. There was a real risk that they were just not going to be able to pay these off. The company was negative cash flow, and competition was increasing. Their prospects did not look very good. So this deal solves that. So they now got the extra 220 million in cash, and they got the term loan from Disney for 145 million, which they can use to pay off that 2026 note. And now this combined entity will be cash flow positive, and so these losses will end, and they can just survive at the very least, right? At the very least, this business is now on a sustainable footing, whereas previously it was not on a sustainable footing. There was big questions as to whether or not it would be around after 2029 when all of these loans were going to be due. So great news for Fubo and Fubo stock investors.
Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.